at Metropole TVKE across all your social media platforms. My name is Simba Kiage. Welcome to your official sector trends this morning. Let's take a step back and talk to you about issues, financial matters, your financial education, which everybody does need to know. We are way beyond half the year, so it's time to look back and see exactly where your investments have been, or if you've not started, then it's time for you to begin. Now, today, we talk matters financial education for all, or in other words, practicing wise money skills. Now, engaging with us this morning is Robert Ochieng, who's the CEO, Abojani Investments, Financial Literacy Institution. Robert, good morning, sir.
Good morning, Simba. How are you?
Fantastic. Happy to have you around, Robert. Every time you and I speak, we're looking at the stock market, we're looking at how the economy is performing investment-wise. But now let's take a step back, Robert, and talk about Abojani today. And then talk to me about what you're really trying to achieve at Abojani, and then come back and talk to people why indeed they need to look back and talk about financial matters and investments and how they can begin their financial journey any other time. Let's begin from there.
Thank you very much, Simba, for having me. So basically, at Abojani, what we are looking at is to help individuals connect their life goals with their personal finances. Yeah, so when you look at the world of finance, you have different phases of finance. So yes. For example, we have public finance, where we look at the inflation, the national budget, tax collections, and then you're able to run a country. Then you come to corporate finance. People talk about companies, Safaricom, KCB, Equity, how they run their organizations to help them achieve their missions. So when it comes to personal finances, actually it's the business of you and me as the individual. So that's why it is said to be very personal. Very personal because life goals are personal. And no one knows this better than the individuals themselves.
Yes.
So we realize that there's a gap because we usually tell people that money is actually a silent life partner. So there are so many things that we are doing in life. We work, we are in business, we do so many things. We are leaders in countries, in organizations. But at the end of the day, if something happens to that business, if something happens to that career, what will keep you going as you think of the next step is money. And we realize that it can actually help us to live fulfilled lives because you have personal goals that you want to achieve.
Yes.
So there are people who want to start businesses, there are people who want to take care of their children, take them to good schools. So all these are dreams and aspirations. Some want to go for holidays, and they just want to feel like they're doing something in their lives. So most cases you'll find that once you plan your life goals, the money will help you. So we usually tell people that we have personal finance as a value chain. So unfortunately, you'll find that people do so many things, very technical stuff like flying a plane from Kenya to the US, doing surgery, businesses running in town, left, right, and center, and they succeed in those things. But when it comes to their personal finances, there's no one to push them and hold them accountable. So we realize that it is necessary literacy that everyone needs to know, just like we know numbers. You might find people who have not gone to school, but they're doing business. They know how to count cash and things like that.
Yes.
And we feel that it's very, very important for as many people as possible to get this education. And we believe that with it, it will help people to even be more responsible as citizens, as leaders, as business people, to know that resources are limited. And at the end of the day, when you talk about the economy, it's not about Robert, it's not about the president or Simba. The economy is getting the best out of life, the quality of the decision that you make with the resources that you have. And we've seen that in some countries that have really done well. It is just a matter of some movements. Like in the US, they have technology, Silicon Valley movement. So it was just about production and creating value. So that's why we tell people that personal finance is a value chain, and it is important to look at it that way. So I'll quickly talk about the value chain that we created at Abojani to help people see finance from a different angle.
Yes.
So this value chain, it consists of 12 phases, and usually say that when you look at the value chain, it's basically your personal finance empire. So when we hear that the Roman Empire collapsed, or we hear the stories of Mansa, so kingdoms and empires, they collapsed because there was something wrong somewhere. So when you look at the personal finance value chain, we look at financial planning. So that is looking at the inflows and outflows, where the money is coming from and where it is going to, and how much you can set aside, and just looking at our goals, then prioritizing them. Because I believe even people with a lot of resources or companies, they usually say that in this year, this is what you are going to do. So planning is key. And after planning, is very, very important to know where you can put this money. So again, we look now at wealth management, which is basically looking at managing your resources. So first is to protect the downside, because whatever you have to ensure that it can help you to get more. So we look at the risk profile of the investor and what they want, beating the inflation rate. So when we hear that the fuel prices have gone up, we just see that the next thing is inflation.
Yes.
So currently it is at 6.57%, and it could go up. There's a very high likelihood that it could go up. So basically, when you look at wealth management and investing, for us, we define investing as putting your money in places where you can get returns above the inflation.
Yes.
Yeah. So if you can get above 6.57% for now, you'd be investing. So that is wealth management. Then after that, we look at debt management, because this kingdom, we can work very hard in this kingdom called personal finance, work very hard for 40 years, 30 years, 20 years, 15 years. Then one day you just make a bad decision and it just brings everything down. We've seen that one happening. So it's just good to be aware that it is one of the weak points. If you are going to take debt, it should be responsible debt that won't eat so much into our earnings in terms of repayments. Then the next one is retirement. So under retirement, what you look at is basically the fact that there's some non-knowns in life. So we would assume to be strong forever, but we know we can see maybe from grandparents or those who have been ahead of us that people get them. You'll have wrinkles and you won't have the energy to work. So we usually say that there's a trade-off between human capital and financial capital. So when we are young and we're able to work, we have a lot of human capital. We can do so many things. And that's the time that we are required to put aside part of our income to build our financial capital. So financial capital is the one that will take care of us when we can no longer be able to work. And it is all about cash flow and liquidity. If you can get regular income for you at retirement, the better for you. Then still under value chains, we look at home ownership. So just making the decisions on the house under you, the roof under your head. So are you going to rent? Are you going to build a house? Are you going to buy? So that decision, some people usually confuse it with retirement. Some people think that the retirement package is for building a nice home.
So it's not supposed to be.
Yes?
It's not supposed to be. Is it possible to view retirement and home ownership as one thing?
Very difficult, because home ownership is just where you stay. But retirement is about cash flow, because now you can't work. You just need a regular, let's say 20,000 Kenya shillings per month, or 50 or 30 to keep you going.
But then
so it doesn't matter how,
it
doesn't matter how big or nice your house is. If you don't have food to eat, it will be crazy. And statistics say that in Kenya, about 80% of poor retain the retirement age. They can't support themselves.
Pretty much.
They have to rely on their children, social support and things like that. Yeah, so still under value chains, we have finance for kids. So if you are going to build this personal finance empire and you want it to be Robert or Simba 2.0, you want your empire to grow beyond you, it is important to take the children through the finances so that they start learning that money does not grow on trees.
Pretty much. Robert, also, let me also get to jump into that area. Is an area that probably I'm also preparing for. When we talk about finance for kids, Robert, are we talking about saving for your kids or also teaching kids about finance?
So actually both. So first is to help them learn the concept of money.
I see.
So that they know that daddy or mommy, wherever they go, they create value and that's how they earn income. So that is important. So usually it's just knowing that finance is a byproduct of what you can be able to do. You can be a plumber.
Yes.
You can be in the media industry, finance industry. Then because you can create value for other people, you'll earn. There's no one who ever earned money from nowhere. Even billionaires, they create value for other people, then they earn money.
Yes.
So it's important for them to learn those concepts and also learn about social skills, because for you to get any opportunity, it will be because other people are aware of your skills. So very, very important for them to learn to interact with other people. And it is important that you help them save and even take them to the bank. They can go to, let's say, KCB, Equity, Corp, see actually this is where money is kept, so that they don't just think that comes from heaven or from nowhere.
Yes.
So it's important for them to learn this over time and even helping them to become part of the business.
Pretty much.
And talk about wisdom. Wisdom is just knowing what not to do. And I believe adults have more experience in life than young kids. And usually people say that if your parents have money skills, they might be good people, but they don't help you much with that. So it's just important that you also. So for kids, it is important because you've seen that sometimes kids fight with their parents, and some actually wish their parents could just die so that they get it. So it is that bad.
And that's probably because they can't give you what you want, isn't it?
Yes.
Yes.
Important. Yeah. So the other pillar is finance for couples, people relationships. Again, we have two people from different backgrounds, different family. For the future. So you have to find a trade-off. So with languages, so that you know that it is not money that makes people happy. There are people who are just happy with us spending time with them, sharing with them new skills, using words of affirmation. So you have to know those and know the purpose. And when it comes to managing family finances, you'll find that someone is very good in short-term stuff like household expenditures and things like that. The other person might be good at long-term investment and things. So
yes.
It's good to outsource. You let the other person take charge, so you can be that someone does something that they are very comfortable with.
Robert, when you talk to most of the couples, just for anybody who's listening and may want to come in and then take those extra classes with you, Robert, at what point should a couple, when we're talking about a couple, are we talking about on a basic level, at what point should a couple talk about their finances?
I think from the get-go, because it is important whether they are boyfriends and girlfriends, money is such a big issue, it is such an emotive issue.
Yes.
And people get into debt because of their spouses, girlfriends, and boyfriends. We've seen there are some boyfriends who are taking advantage of their rich girlfriends. There are also girlfriends who are taking advantage of their boyfriends and things like that. So it's just important to know it can actually be the end of that relationship. And also it's good to let people know that
yes,
they're your boyfriends or girlfriends and things like that. But that relationship with the money is different. So even with friends, they're your friends, not the friends of your money.
Yes.
So it's very, very important to know that personal finance is personal.
It's personal finance, isn't it? And Robert, I'm sorry to cut you short there because it's a very important one this morning. I mean, want somebody to come in and take that class. I might be the next one, by the way, on this. Well, they say your personal finance, how much you earn, how much you're making, is your personal issue, your personal secret. Is that a fallacy especially when you're talking about this in relation to a couple, that you got to tell each other?
Okay, so what I would say is that what we need to learn about couples is that these are people who have decided to share their life journeys. So I don't think if there's any secrecy there. So there's no secrecy when it comes to couples, because
Yes.
when you're building the life together, you need to know the resources that you have at your disposal.
I see.
And we've seen that actually the best economies that we can look at, you'll find that most things, they actually favor people who are in relationships or married. So they're just trying to look at a household, because even Kenya, when doing census, household is such a big thing.
Yes.
And for home ownership and even rentals, in some economies, they count house affordability as the total income in the house. So they look at what the husband is earning, what the wife is earning, and then they say if it is 200,000, then house affordability, you should try not to spend more than 50,000 on rent.
Pretty much.
And things like credit score in some economies, it is shared. So if one of the couples is misbehaving, it will affect the other couple. And we've seen that when we consolidate income, which is a weakness that you have here in Kenya, we still fall for the fallacy of being independent. But you don't know that to get ahead, even in business, you need to work with other people. So we need to look at the possibility of consolidating our income.
Yes.
It will lessen the problems that we'll have, and it will allow us to achieve more. So I would still encourage couples, if they can, that's again personal for them. But if they can consolidate income, then it makes the work very easy and they'll achieve their goals faster. Rather than saying that you are in a journey together, but everyone is doing their own thing.
Pretty much.
So if they consolidate the income, they'll have more for school fees. And even when the children grow up, it will be much easier for them even to help them raise capital to start businesses. Yeah, so that's the family is where you can do all these things that you want other people to do. So if you want capital for startups, we start with the family. If the dad and mom are able to fund the kid with some money for startups, we'll do much better. But you find that because we don't consolidate our income, there's a lot of wastage, so that it is again the children who are supporting the parents. So that's when we can make a decision to work on it as this generation, so that things can get better over time. But consolidation of income, even from a business point of view, it becomes very easy to do the handshake from one generation to another.
Pretty much. All right, Robert, if you could go through the next 5 in 2 minutes, and then I put 1 minute questions to you. It's a quick response, so that we now get out of this as well, Robert.
Yes.
All right, so this is another question to you, Robert.
Yeah.
Under personal management, under personal finance management for a young adult, and this is a question from 24 to 30, where should I begin?
So thank you very much for that. So usually what we tell people is that for you to understand personal finance, we look at 3 pillars. So the first is the mindset. So mindset is very key. Then we'll go to the skill set and finally tool set. So the mindset is personal again, having a meeting with yourself, deciding what you want for your life, and accepting that you need to set aside part of your income, because some people don't believe in that. So you have to see that there are things like inflation, which basically will require you to be investing and growing your money. You have things like retirement coming up, personal goals, maybe you want to buy, and you also have emergencies that come up. So it's very important to have a meeting with yourself and know why you need money, and say what money means to you, whether it means independence, survival, freedom, things like that. So that way it becomes very easy for you to start your personal finance journey.
Pretty much.
Then the skill set pillar, is about learning the financial markets, what is out there for you. Then you go for them, not the other way around. Because if you don't learn, people in the financial services industry will be coming to you, but since you don't have the knowledge, you're likely to make big mistakes. Then finally is the tool set. We can have all this knowledge, but we do nothing about it. So it's important to open that investment account once you've understood the financial markets, that circle account, and get started. Yeah, so once you get started, the next thing is to be consistent and make a connection with big goals that you have in life, so that it is easier for you to do this naturally. Because if there's no connection, then it becomes very difficult.
Pretty much. Last question that is very important this morning. There are 2 actually, but I'm going to put them together. Number 1, save and then invest, or start investing small? And number two, are there ratios that I should respect out of my income in terms of rent, education, transport, food, leisure, and all that? And how do you make sure that then you don't step out of it? I want you to respond to those two questions in a minute, Robert, as we step out.
Yeah, I think so. The first thing that we look at, saving actually happens in the mind in terms of planning, but there can be a very thin line between saving and investing, because investing is putting your money in a vehicle that will give returns above the inflation.
Yes.
So what we say is that to start the journey of investing, we play defensive first, and playing defensive is to start with an emergency fund. So you can do that for even 1 to 1.5 years. Just set up an emergency fund. So that emergency fund, if you have it, it will really free your mind so that you can start investing from a long-term point of view. Because things come up, you might need to just buy a new phone. So when it comes to budgeting, we encourage people to use the 50, 30, 20 rule. So 50 basically is about the needs. So needs are things that you need for basic survival. So when you are looking at the COVID lockdown period last year, those things that you need for the bare minimum in terms of survival, like food, rent, you should spend at most 50% in that. Then 30% goes to self-development. So self-development, basically there are wants. So these are things that you need to do for your body, mind, and soul. So things like supporting your parents, going back to school to build your career. If you're in business, learning about new skills, because the more you learn, the more you're likely to increase your earning.
Yes.
And supporting friends, so that falls under 30%. Then you have 20% for building your future. So that's investments, what we put in the stock market, circles, treasury bills, and bonds. Then now overall in terms of expenditure, there are certain ratios that you should respect. So first is debt to income ratio. So if you are going to have some loan, try to ensure that you don't spend more than 25% of your net income on loan repayments every month. Because if you go beyond that, it will affect other things. Then also rent, if you are renting, or if you are on mortgage, you are buying a house, try to ensure that house affordability ratio, which is the total money that you pay for rent or mortgage over your total income as a household, it should not again exceed 25%. Because these two, debt and rent, they are known to be the weak links, where the money starts disappearing, then it affects so many things, we fall into debt. So I would say that those are very important ratios. But if someone is young, they can even increase how much they are saving. The more we can save, the better, because any saving that we make today is actually enabling us to buy our future for free, where we won't need to work. So it's very, very important to make those connections.
Pretty much. Well, but you and I could go on the whole day just trying to understand this, but I'm afraid we have to end it there. So for anybody who really wants to start their investment journey, wants to know exactly how to go about this, you don't know exactly what it is, you can talk to us, or you can just visit Abojani. And then after that, you can log in and register to some of their classes and actually get started on these ratios that we're talking about here. Very, very important. You hear what Robert is saying? You just gotta start. And then after that, you develop your mindset, toolset, skill set, and then pretty much you're already there. Robert, thank you very much for taking your time this morning to speak to us here at Metropole Television.
Thank you for having me, Simba.
Anytime, man. Always a pleasure. We take a short break, but once we come back, 2020, were the banks the biggest once we come back? Let me stop there. That ran away.